Next up, we've got a session on investments with one of the fund's external advisors, and that's with Marian. So I'm happy to hand over to you, Marian.
Okay, thank you very much. I'm briefly going to run through what's been happening in the investment fund over the last year. So I'll cover the following topics. So I'll briefly talk about the investment backdrop and what's been happening in the market since the end of March 2021 to March 2022. I'll look at the evolution of the fund value and asset allocation, make some comments on performance over the short and the long term, and also some observations about that and future asset allocation. And then I'll make a few comments on the sort of things we'll be focusing on in the investment panel over the next year. So for the financial year up to March 2022, global economies continued their strong recovery post-COVID. However, labour shortages, particularly in the UK in terms of hospitality and transportation, along with disrupted supply chains and higher energy prices in terms of fuel, began to see inflation start to rise towards the end of the year. And as a consequence of that, the Bank of England raised rates in December 2021, and they were shortly followed by most of the other major central banks, such as the US Federal Reserve. Towards the end of the year, as Rodney's already mentioned, Russia invaded Ukraine, and that saw a significant rise in oil and gas prices, together with rises in commodities such as wheat, sunflower oil, fertilizers, etc., which again saw the rates of inflation spike dramatically, and I'll talk about that further later on. So the year ended with equity markets having performed well initially, but lost some ground towards the end of March, just as because of the Ukraine crisis, and bonds struggled to perform well, given the fears of inflation was more than temporary. So on the next slide, I show you the returns for the 12 months to the end of March, and I won't go through all of these, but on the left-hand side, you can see the negative return we had from UK government bonds, and that's because of inflationary fears. But in the middle section, you can see the returns that we had on global equities, which were generally positive, although European lagged behind for obvious reasons due to Ukraine and Russia. And on the right-hand side, I show the return on property, which is one of the alternative investments we've got, and we'll see later that private equity and infrastructure also had very good years. So in terms of thinking about the evolution of the fund, on the following slide, at the end of March 2021, the fund had a value of just over 16 billion. There were some net transactions during the year, but the key change was the market impact and the income earned from the investments, which was over 1.7 billion. So that at the end of the year, the financial year, I should say, the fund had a value of about 17.9 billion. And where did the majority of that return come from? So on this slide, you can see that the key drivers of that in pounds amounts were from the equity portfolio, which had an increase in value of over 750 million, and the private equity portfolios, which had a really good return last year. On the next slide, I show you how the asset allocation changed. So from the end of March 2021 to the end of March 2022, our exposure to equities fell. That was in line with our strategy. Fixed income and property remained broadly the same. And again, in line with strategy, alternatives went up. We also increased our cash weightings, as towards the end of the year, we felt nervous about expected future volatility, so allowed those to drift higher as we received income from investments. So on the next couple of pages, I talk about the performance of the fund. The fund has a fund-specific benchmark, which is chosen in order to exceed the return assumed on the liabilities, and it's picked specifically for the West Yorkshire Pension Fund and takes into account the risk appetite of the fund. And so on this page, we show that the return on the fund for the year was 9.9%, and that exceeded the benchmark of 8.2%, which is really good news. And also here I've got the local authority average of 8.6, which again, it exceeded. And I'll come back to talking about that later. So just looking at those return figures versus the benchmark in a bit more detail. So on this graph, on the yellow bars represent the fund's returns, the blue bar represents the scheme-specific benchmark, and the green is the relative return. In other words, the yellow bar minus the blue bar. So the good news is that you can see over all those long-term periods that the return on the fund has exceeded the fund-specific benchmark, and just as importantly, it's also exceeded the liability discount rate of 4.35% that Sam discussed earlier. On the next slide, again, but it's very important to remember that your liabilities are linked to inflation in terms of salary rises and pension rises, which both Rodney and Alison and Sam have discussed. And so I've shown here, again, yellow bars are the fund, blue bars this time are CPI, which is the government's measure of inflation. And again, you can see over the long term, the fund's return has exceeded inflation. So if I just make a couple of other comments about fund performance. I mentioned earlier, while it's most important to look at the fund's specific benchmark, it's sometimes useful to look at where the fund is in comparison to other local authority funds. And so here again, yellow is the fund, blue this time is the local authority average return, and green is the difference. And you can see this year we beat the local authorities average, but over the long term we've lagged slightly. The key question to that is why. And on the next slide, I give an indication of the reason behind that. So on this fund, on this slide, you can see that the returns here are for the last 5-year annual periods on the left-hand side, and the longer term position on the right-hand side. And you can see that with the exception of 2022, the fund has underperformed within its equity portfolio, the other local authority funds. And again, the reason for that is illustrated on the next page. So the investment team do a good job on their individual portfolios, outperform their benchmarks. But you can see here on the left-hand side, the fund has in blue 28% in UK equities, and in orange 37% in overseas equities, which is about 65% in equities in total, and another 15% in alternatives. And if we can compare that with the local authority average, they've only got 10% in UK equities and 42% in overseas. So a total there of 52%, and the splits there are around for the fund is a ratio of about 45 to 55 UK overseas, but for the local authority average, it's about 20% at 80%. And that's one of the key drivers of the returns, because overseas equities over the long term, at the last 5 to 10 years, have outperformed UK equities. So again, the key question there is, what are we going to do about that? So on the next slide, I show you at the end of 31st of March, which is the second column there, the asset allocation versus the long-term target, which is that middle column. And over time, we are planning to reduce the equity exposure down to 55%, and that will be invested in government bonds, property and alternatives to bring us closer to our long-term strategy. So just briefly, before I move on to what's been happening since the end of the financial year, I just wanted to mention three other key achievements that the fund and the team have been working on over the last year. So there's revised responsible investment policy, often called ESG, environmental, social and governance. We've become a signatory to the UK Stewardship Code, which is all around how you manage your investments in a proper and prudent manner. And we issued our first TCFD report. TCFD stands for the Task Force for Climate-Related Financial Disclosures, and that's all about climate change and the amount of carbon emissions, etc. we have in the fund, and that was a great achievement, and work is now progressing on next year's report. So just to think about what's been happening in the market since the end of the financial year. And on the next slide, this illustrates what's been happening with inflation, which I'm sure many of you are fully aware of, and Alison has already talked about in depth. And this slide shows inflation from the late 80s to the end of August. And you can see for the last sort of 20, 30 years, inflation's been relatively low. There's been some volatility there, but it's been relatively low. However, since the end of 2020, it's started to increase, and it's increased very, very sharply over the last few months. And indeed, as Alison said earlier, inflation hit 10.1% for September. The result of that, which is the highest it's been in over 40 years. And I also should say that it's not just driven by gas and energy prices. Inflation now, which I'm sure you're aware of when you do your own shopping, is very widespread. So it covers food, clothing, holidays, all services, etc. So as a consequence of that, the Bank of England, now that it's quite clear inflation is no longer temporary, has started to raise rates. So apologies that these graphs are a little bit small, but on the top left-hand side, this is the short-term interest rate set by the Bank of England, and the dark blue line is the rate since the end of the year. And you can see that that has slowly increased at each of the bank's meetings. And so we've now gone from a rate of 0.1%, where it was unusually low for a long period, and now we're at 2.25%. And the pale blue line is just to show this is not just a UK phenomenon. That is the US Federal Reserve increases, and you can see they've been increasing as well, and they've actually overtaken the UK with bigger and higher rates. The graph on the right-hand side is the cost of borrowing for the UK government. And you can see here that at the beginning of 2022, we had a cost of borrowing in the region of 1.25 and that has slowly increased. And again, recently that has really gone up since the middle of September, following the mini budget and all the very well publicised political things that have been happening. And I won't go into the politics, but now we've got a new Chancellor and we've seen that come down a bit. But the effects of that will increase mortgage rates for a lot of individual people, and it will also increase the cost of borrowing, not only for the government, but for all sorts of different companies. So turning on to the next slide, I just want to show you what's been happening in the equity markets. So on the left-hand side, this is the return on the UK equity market in blue since the start of the year. And on the right-hand side, this is the return on global equity markets since the start of the year. So really, since the end of March, both markets, or global markets, have generally fallen. That's because, as I said, the cost of borrowing has gone up and markets are concerned about corporate profitability and the global economy is falling into recession. The Bank of England have already announced that they expect the UK economy to be in recession next year, and markets are very concerned about how long that will be, and therefore that's led to a negative return, which Alison mentioned earlier. So what has that meant for the fund? Well, on the next slide, you can see at the end of March 2022, as I said earlier, the fund had a value of 17.9 billion. The key driver of the fund since then is the fact that, you know, we've lost about 875 million in terms of the market value, in terms of going down. So the fund is now worth, excuse me, just over 17 billion. However, it is above where it was at the start of the last financial year, March 21, where it was worth just over 16 billion. So I'll just close with saying a couple of things about what we're going to focus on next year in terms of the work of the investment panel. So we're going to continue reducing the equity allocation. As Alison's already talked about, the results of the actuarial valuation will be available soon, and following that we'll do a big strategic asset allocation review. We're focused very much on recruiting staff and filling some of the vacancies in the investment team, and we'll continue to enhance responsible investment policies and reporting, and talk about and we'll enhance our governance structure, which Philip will talk about shortly. And from a tactical basis, we'll continue to monitor the growing economic risks, including inflation and slower growth, recession, and try and identify and monitor the new opportunities in alternatives and other asset classes. So thank you very much for listening.